Good morning, good afternoon, good evening, depending where you're from. Welcome to the ITC SheTrades webinar series, today focused on Absa Bank Kenya, which will be focusing on cash flow forecasting and management. So I'm very happy to be with everyone here today. I kindly ask that, again, you keep your camera off and your microphones on mute for us to have a smooth presentation. And I just would like to let everyone know that this webinar is being recorded. We will be sharing the PowerPoint presentation, and we will be sharing the full package of Absa Bank's previous webinar and PowerPoint, and this webinar and PowerPoint. So please do use the chat box if you have any questions. And also, if you could please stay to the end of the at the end of the webinar, if you could just please give your evaluation of this presentation, because it's just one question, so it won't take too much of your time. And I kindly once again ask you to keep your microphones on mute and your camera off. With that said, I'm happy to start this webinar. This is just a quick introduction of the ITC SheTrades Invest team. We have here Anna Mori, who is the project and partnership manager. Myself, Leticia Johnson, I'm the project coordinator. We have Marco Aletti, who is the access to finance expert in the house. We have Nina Jason, who is our communications expert, and Hanan Taifour, who is our advisor, and Mo Ibrahim fellow and supporting of SheTrades Invest. Just to give you all a quick overview of SheTrades Invest. SheTrades Invest falls under the umbrella of the SheTrades Initiative, which aims to connect women entrepreneurs to international markets. SheTrades Invest is the investment arm of the initiative, which connects eligible women entrepreneurs with the right impact investors, financiers, commercial banks, microfinancing institutions. And at the same time, we help our entrepreneurs become investment ready through different trainings, workshops, webinars, coaching, mentoring, and e-learning courses. So without taking too much time, I'm happy to pass on to Absa Bank. And today we're going to be having the cash flow management. And who's going to presenting today will be Ms. Caroline Wambungu. She's the head of finance decision support. And we also have Ms. Susan Situma, who is the head of the SME banking. I kindly ask that you all use this opportunity to ask questions ask questions to the experts. This is a very sensitive time, a time of uncertainty, and from our surveys that we're very grateful that you always respond to, a high number of you have voiced out that cash flow is a problem during COVID-19. So please do feel engaged, ask questions. We're going to have a questions and answer sessions at the end. And if you want, you can start asking your questions on the chat box and we will get back to you. Excellent. In this case, what I'm going to do is the following. I'm going to introduce Ms. Susan Situma, and then she will be introducing Ms. Caroline Mbungu, and we start off with the presentation. And Ms. Susan, she will come back to focus on the offerings of Absa Bank Kenya. Thank you. So we have with us Ms. Susan Situma, and she's currently the head of SME banking at Absa Bank Kenya. She has a role she has held for the last 4 years, and in this role, she is responsible for growing the SME business for the bank. Prior to joining Absa, she was head of SME and agribusiness at KCB Bank. She has a wealth of banking experience spanning over 20 years, working in various roles, including customer service, risk and credit analysis, corporate relationship, and SME. She has a great passion for serving and finding solutions for SMEs who are the backbone of Kenya's economy. She has over 14 years of experience in this area, having started as an SME banker to running the banking of SME business. Her areas of expertise include SME strategy and development, SME finance, product and development, credit analysis, risk management, client relationship management, and managing larger sales teams. She has been involved in several key SME initiatives in Kenya, as a speaker, notable ones being the first Kenyan SME Day facilitated by the World Bank and the first Africa SME Finance Forum facilitated by the International Finance Corporation. Susan has done various banking and leadership trainings. Most recently, in June 2020, she graduated from the executive training of the Female Future Leadership Program facilitated by the Federation of Kenya Employers that emphasizes the network building and peer mentoring, as well as board competence. In August 2020, she received a recognition from her Absa colleagues for being an authentic leader, being authentic as a leader for her inspirational leadership. Susan, it is an honor to have you here today. Would you please say a few words, and then you can pass it on to Caroline. Thank you.
Thank you very much, Letitia, and indeed the ITC team for facilitating this session for us to be able to have this conversation with the women entrepreneurs, both in Kenya and outside. We are really excited to host you, and we are looking forward to having a very engaging conversation with yourselves. So first things first, I really pray that you're keeping well, you're observing the guidelines, and you're keeping yourself safe. I think during this period, as Absa Bank Kenya, we have continued to resonate with our entrepreneur customers, especially within SME business. And we have had various interventions to support, make sure that their businesses continue to run during this period. So we have just concluded phase 1 of a series of Absa webinars where we were partnering with Grasa Marshall Trust to just support and give a lot of practical skills that you can use during this period. And if you missed any of them, do feel free to go to the Absa Bank Kenya YouTube page, and you will find quite a number of videos there on some of the different things we talked about, whether it's leadership, emotional intelligence, whether it's fundraising, which was just our last topic. And I think if some of you joined this last session that we had, I think it was last week, you will be able to get quite a number of more detailed, probably information around how you can access finance, but I will touch a little bit about it later as well. So really feel welcome. I'd like to mention that we have Absa Bank Kenya colleagues, both that support the SME business. So I've seen our head of trade finance, Edwin Asiema. I've seen Caroline Onyango, who did a very good presentation to the ladies last time on some of the product offering and Absa offering that we have for our SME customers. So she's also here. We have, I've seen our ESD head, Karen Kiambi, and we have various cluster managers that support run the SME business. So they will be at hand during this conversation to help answer any questions just as they come in. And therefore, I really seek that we keep the conversation going even on the chat, so that then as you ask, we'll be able to intervene and get you some more information. Should you need further coaching this particular subject, I know it's really key. It's like the blood that runs in your business. If it's not there, your business dies. So therefore, it's a very key conversation. And if you need coaching as part of the partnership that we have with ITC, we'll be able to do that. And you can be able to ask for that intervention as well directly to us or to ITC. And we'll be able to facilitate a session where we can do a little bit of a deep dive on what your business, where you are at, and the kind of interventions that you can have for your business. So with that, without too much ado, then I would really like to introduce our speaker, our main speaker for today on this cash flow forecasting session. And probably you can put her slide next. So she's Caroline Wambogo. Caroline Wambogo is a colleague. So we work with her here at Absa Bank Kenya, and we're really utilizing all our expertise to support SMEs during this period. So she's a seasoned accountant, having served in different capacities over the last 17 years in the banking industry. I previously worked with her actually at NCBA Bank before joining KCB. So I've known her for quite some time. She's currently Vice President in the Finance Department at Absa Bank Kenya, which is a role as Head of Finance Decision Support, dealing with strategy, planning, budgeting and forecasting, investor relations, and management reporting. So you can imagine, she does forecasting for Absa Bank Kenya. So I really asked her to break down this for an SME, for an entrepreneur who's just starting out. What can they do? But she's not new to that. So I'm really confident that she'll be able to deliver on this subject. She sits on the board of Absa Bank Insurance Agency as an executive director. She's also a chair of diversity and inclusion at the bank, a key shareholder in driving the Women Network Forum, agenda within Absa Bank Kenya, and other facets of diversity. She holds a Bachelor of Commerce degree in accounting from the Catholic University of Eastern Africa and is a certified public accountant. She's also a member of the Institute of Chartered Public Accountants of Kenya, ISPAC, and is currently finalizing her master's in business administration, strategic management. She's a 2017 top 40 under 40 finalist and enjoys mentoring young people as her personal contribution in shaping the younger generation. I must say she also does various things, but since they're not here, I will not mention Caroline, but I'm very confident to be able to resonate with the women entrepreneurs that have joined us. So you can proceed and share with us, then I'll come back later. Thank you.
Yes, thank you so much, Susan. Sorry, Caroline, I'll stop sharing my screen and I'll let you share yours. Thank you.
Yes, thank you very much, Susan, for that great introduction. Of course, as my colleague, we do quite a lot together, and she's alluded to that. Thank you very much, Letitia, as well, and with the ITC team, with respect to giving us this opportunity and platform to be able to discuss this very critical subject on cash management. I think before we get into it, since I know we are all very enlightened in this area of management of cash flows, we all do it in our personal lives, in our households, and now also in our businesses. I would like us maybe to run a quick poll, then we get into the gist of the matter, just as we gauge ourselves how well we have fared in the poll and what we are going to do differently so that we can fare even much better. So there is a poll right in front of you. If you could kindly just click on the answers to those 3 questions. So there are 3 questions. If you could kindly just click on those answers, then we quickly get a position to work with even as we go to continue together in this particular presentation this morning. I can see the responses coming in quick and fast. We are doing very well. Thank you for the responses. Thank you as you continue. We are at 45%. Moving on to 55%. %60 of us have already voted. Giving a bit of time for a little bit more.
To everyone who hasn't voted, this is going to give us a very good overview of how we can help and address the challenges of cash flow. So if you could please just take your time to fill out the poll, just for everyone to know this is anonymous. We don't know who is answering what. So it's just for, it's really just to give us an overview of how you're handling the, you know, your cash flows, especially now during the pandemic. So your contribution, it will definitely help us help you, if one can put it.
Correct. So I think, Letitia, we can give it 30 seconds more. We close the poll.
All right, excellent.
Okay, so Letitia, I think we can close at that point so that we share the results.
Would you like me to share the results?
Please do.
All right.
Very nice. So thank you so much. I think that was about 71, 72 response rate from those that are tuned in. This is very good in terms of the information that you have given to us, and I believe quite authentic there. In terms of how effective we are in managing our cash flows, because I trust we all do agree that managing cash flow is a very key component of what we do in our daily lives and in managing our businesses. A good number of you are saying you're very good at it. You're managing it well at 60%. There is 33% also saying that they're struggling in that area. So I guess some of the tips, some of the information that we shall share this morning will be quite useful. And 6% of us, thank God, are saying they're great and thriving, which is a very good thing. So I hope and pray that as we go along on the chat section, you'll be able to share with us some of the tips or some of the things that you have seen work for you so that we can enable everybody else to rise and thrive with us. On the second question, have your cash flows been affected by the pandemic? I'll start with the most highly rated, that for most of us, 41% state that they have decreased by over 50%. So they've been largely impacted by this pandemic, which is quite unfortunate. We do appreciate and of course know that quite a number of businesses have slowed down, others even shut down. We've seen other people even take different lines of business just to try and survive this pandemic. But we know it's also for a season, so it will definitely come to pass. Others talk about 38% that have decreased below 50%, so have been affected, but at least have 50% of their cash flows working for them. 16% actually say that they've not been affected at all. So it would be nice to get a bit more insights as to what you did differently so that you were actually intact from a cash flow management perspective. And then we have 5% who clearly were not affected at all, but even if at all, they increased their cash flow. So 5% of you may have seen opportunity with this pandemic, and that would be nice to also hear what are some of these opportunities that you are able to quickly switch to and therefore increase your cash flow. And to the last questions on what you consider to be your greatest area of challenge in managing your cash flow, 40% of you say unplanned expenditure. If this was a talk around household management of your expenses in the household, I would have given you a terminology of what we call unplanned expenditure in a different forum, something that I even use in my own family with my children, and we actually just call them shiny things. So we always say, keep away from shiny things because that's unplanned expenditure that dovetails your cash. But of course, we have 37% of us saying debt collection challenges, which is really key, and especially in running businesses where you have these accounts receivables and you have to find a way to ensure you collect the cash so that your cash flow conversion cycle, and we'll get a bit into that, is not affected, how quickly you turn around your stock into cash and be able to reinvest it back into the business. For 24% of you say lack of proper planning, and we'll share a bit of tips on how to do a proper planning, cash flow forecast, so that that can also help you in that area. So we really want to appreciate you this morning for your candid feedback through this particular poll. Thank you for that. So we'll now get into the business of the day as we ponder on some of the things we've just touched on. And just to start my presentation, cash is key and is king. I mean, you've heard of this said over and over again, that cash is key and is king. And we say it is actually the fuel that powers up the business engine. You know, this is an age-old saying, which is often used to even explain the failure of both businesses and consumer households. Because as I said, the information we'll be sharing with you cuts across, because cash is cash, you know. So it actually does pan across. And yes, it is true. Without proper management of your cash on hand, you will run into major trouble and you may even be forced into bankruptcy. So it's a critical subject that I pray that as we go along, we'll be able to catch some tips on what we can do differently, what we can do to improve our cash flow positions through employing certain things into our businesses so that we keep our focus on cash at a very focal point in running our businesses. So as we get onto this, allow me to get into the content so that we can get to really appreciate some of the things we'll be discussing with us this morning. So we'll talk about, you know, how our cash flow position matters and why it does matter. We'll talk a little bit about the forecasting. We'll talk a little bit also about the cash flow cycle, and also speak into the tips we can employ from a cash flow perspective in trying to manage our cash flows so that we get that also in check. So there are 4 key concepts that we need to remember in cash flow management. And one of them is improving your revenue, because if you really think about it, one of the ways you can improve your cash is either you're repricing your products, or you are increasing your sales volumes, or you are cutting down on your costs, so that at the end of the day, the net increases your margins. So from a business margins perspective, you need to look to see avenues that can help you improve your revenue. So you need to check those business margins, and you need to also correctly and accurately account for all your incomes so that you're able to have proper books of accounts that speak to actually what the business is able to generate. Somebody once said you can have too much activity but no productivity. So our prayer for you is that your activity actually translates into productivity so that you can register healthy cash generation positions for your business. The other one is business forecasting. Forecasting enables you to sustain the business into the future and scale for growth. Business forecasting simply helps you to speak into an unforeseen future based on what information you have today at hand. It's true, this pandemic, nobody saw it coming. So probably, yes, you had done a forecast And because you had not seen this sort of pandemic coming, you definitely did not account for it in that sense. But in as much as we have these unforeseen items that come our way, unforeseen seasons that come our way, a business forecast in a normal running of a business helps you to know when you will need to plug in some cash, maybe from external sources, when you will need to probably scale down, when you will need to probably do whatever it is, depending on the kind of business that you're running, so that you can always be pre-prepared. So a business forecasting helps you to be pre-prepared to be able to, for the business to absorb the shocks as they come. The other concept that is critical for us to remember in cash flow management is, of course, expense analysis. And you did see there from the poll, somebody saying, you know, in fact, the highest number saying that unplanned expenditure seems to be one of the challenges that eats into our cash flow management. So how do you categorize your spending? And do you really understand your business costs? We'll get a little bit into that so that we can see what are some of the things we need to employ. And then lastly, cash flow conversion cycle. From inventory, when you bring in the stocks into your shop, to when you actually sell those stocks to that third party, to that target client, and actually get paid. So remember, if you brought in stock through credit, that's an accounts payable that you have raised in your book. So money didn't go out, but money still needs to go out because that supplier, that distributor needs to get paid all the way to the time you actually sell to your customer. Some pay you in cash, so the conversion of cash is immediate. Some pay you on credit, so those accounts receivables. And you did see from the poll that accounts receivable is also another area of challenge that we need to deal with. So clearly there is quite a lot here that we need to get into and speak, you know, some tips as it were, and maybe share some thoughts on how to go about it so that we can be able to be better in managing our cash flows and better to be termed as thriving people from a poor perspective. So what is cash? So this is common, but I usually like not to assume. So cash is the notes and coins that you have, and I know I'm speaking to different markets and different jurisdictions this morning. The current accounts or the checking accounts, as you say them in some other countries, your short-term deposits, your bank overdrafts, your mobile money. In Kenya, we have what we call M-Pesa. We are able to transact using our phones. I know we have the WeChat from a China perspective and things like that. There's foreign currency and deposits that can be quickly converted to currency, meaning anything that you can quickly convert into liquid cash, then is cash. Non-cash, fixed deposits for, you know, for a longer period of time. Here we cap it at a year. Money due from customers, those accounts receivables, the stock, because it's in stock form, not cash form, and your accounts receivables that you're yet to collect. So that is not cash. So anything you cannot quickly convert to cash, even including property and other investments, then they do not fall into the classification of cash. And this is important for us to know because it is a cash flow management conversation. And what we are saying, cash being king, means you need to be able to have quick and easy access to cash when you need it, both at a personal household level, but also at a business level. So when you look at the cash flow in terms of just simply putting it out to you there, it's all about your inflows versus your outflow and what is left over. So your cash inflow, and if you look at the pictorial diagram there that I picked from the net there, it's a big pipe. So the expectation is that your inflows, your revenue from your sales, from whatever other source of your income is a huge pipe, so that you're bringing in more money than you're taking out. Note that the cash outflow pipe is a smaller one. And the reason for that is so that whatever is left over is sufficient enough to generate more revenue for your business. So we say, in other terms, that is not so much how much you make, but how much you keep is what is critical. Even for salaried people, because then that becomes our revenue, you know. So we can get as much as we do from our employment income. But if you spend as much as you get and you keep nothing for yourself, you will not be able to grow your wealth. You will not be able to empower yourself into wealth generation activities. You will not be able to actually protect even your investments into the future. So you need to ensure that whatever is left behind, after you have received and spent is adequate enough to grow that business. And remember, when we talk about growing your business, is because it's supposed to meet your day-to-day expenses and your forecasted expenses into the future. So we are looking at a business that actually grows and meets your expenses, current and futuristic. So it's very important what you're keeping as leftover after your cost of production, after meeting your business expenses, after paying your workers and the like, what is left over. So I'll give us an example, and we are working with an example here of, assume a Mr. Joseph here in Nairobi, because we are speaking from Kenya. So Nairobi is our capital city, and so it's usually the busiest, part of this country from an activity perspective. So he imports electrical appliances from China, Malaysia, and other countries and stocks them up in his Nairobi shop. And he has a target audience of selling it to retailers at 60%. He has some walk-in customers who are not necessarily, forecasted for at 30%, and he has contractors that he supplies to at 10%. So his cash in comes from sales, comes from collections from his credit customers, comes from any commission he might make because he's also an import agent to other traders. And his payments is the cost of these electrical appliances. From a supplier's perspective, the cost that he spends to actually acquire these particular appliances is a cost out of the business, is a cash outflow. But at the same time, he has transport to pick his goods, but also transport maybe to deliver for his clients, because that again becomes a sweetener for you to be able to retain your customers. He has rent for his office premises and work premises, maybe even rent for a warehouse where he has to store his goods. He's got wages and salaries for his employees, some repairs and maintenance, because there's always wear and tear here and there. And these other business expenses, their fuel, their advertising and others. So you will notice that cash in and cash out rarely coincide, but he must be able to meet scheduled expenses. And this could be any one of us on this call this morning, that you have to be able to meet your scheduled expenses in as much as your cash outflows and your cash inflows rarely coincide in that sense. So there are times he will definitely not have ready enough cash to make these payments. And of course, there are times our Mr. Joseph will have some cash in excess that he's holding, and he's able to actually meet his commitments timely. So cash flow management is about speeding up that cash in and slowing down that cash out through the payments, so that at any one point in time, you're not feeling like you're struggling. And there are many, many business surveys that have been done. And I think if I remember one of the polls that I do remember from a survey done in the US bank actually, and they said that one of the reasons for small businesses, one of the reasons why they fail, I think they came up with a percentage of about 80% of the time is a cash flow issue. So it's critical that we are having this discussion, because then we need to ask ourselves, then how do we manage our cash? So as I said earlier, you can be earning a profit, but you'll be forced to close because you've ran out of cash. Anytime you find yourself in what we call a cash crunch just simply means you're not able to meet your current obligations, be it current obligations to your staff. If you find yourself struggling to pay just their basic salaries, if you find yourself not being able to even buy your own stock for the business, if you find yourself not being able to pay the rent for your premises, yet you have been generating money. It depends, of course, where, number one, you've invested, but it also depends how are your accounts receivable. Maybe you have sold, yes, but not necessarily received the cash to be able to generate and to keep your business running. So making a profit does not necessarily mean that you have cash, because you can actually run out of that cash even as you make your profits. So the cash flow conversation is a very critical conversation. And that's why it involves forecasting, how you collect your money, how you disburse of it, how you invest it, and how you plan so that you can operate smoothly. So the key components or the key requirements that you need to note about cash flow is that it has got these three characteristics. Number one, it has to be positive. You have to work with money that is present. When your cash flows are negative, like when you're operating an overdraft, it means you don't have ready cash. When you see yourself swiping credit cards, it means you're already actually speaking or rather operating from a lending perspective. So you have to have positive cash flow. These are the three wonderful characteristics of cash flow. It has to be available when you need it and timely as to when you need it, right? And to achieve this, I said one of the other key concepts was planning. So you require to plan and focus so that you're not caught unawares. And that is the key principle of cash flow management, planning. So why does it matter to Joseph and to most of us that have logged into this call this morning? It's because you need to sustain your business from day to day. There's what we call operational BAU, running of the business as usual. Your sustenance of that business in the day-to-day running is critical. If you mess with your cash flow, it could just as well be what we call a death sentence of that business. And we have seen in many markets where you have companies that have aggressively even expanded. And in that aggressive expansion, unfortunately puts a constraint on their cash, which unfortunately again brings them down to their knees. And they're either forced to close some outlets or even close the business altogether, because you have suppliers on your neck to pay their bills. You've got your workers who of course need to feed for their families, and they're looking up to you to ensure that you also meet your part of the obligation because they've done their part in showing up and helping you run the business. There are, of course, costs to borrowing. So in as much as, yes, borrowing is an option, and that's why we are running a bank, in this case, Absa, there are definitely costs to this borrowing, and you need to do a proper analysis as to whether your business can be able to meet this cost of borrowing for purposes of ensuring that it is sustainable for your business, even as it engages external parties to be able to access funds, be it through borrowing, be it through those credit cards and any other channels that you may have that fund your business. Even shareholders, if you're running a company and they cannot keep injecting money without getting a sizable return. So cash flow forecasts are a prerequisite for business success. I think I've mentioned that. And then there needs to be self-discipline from your part as a CEO or as the one running the business. You need to have that self-discipline and good management so that you can yield positive results for the business. So that is why it's very critical for my client Joseph and yourself to be able to think about this cash. What about expenses management? So we talked about the various types of expenses that Mr. Joseph here would have, which I believe, mirror what also you would have. And it's important to agree with us that when it comes to expenses management, you should have a good feel of how your organization expenses are classified and how they behave relative to sales activity. You need to know your costs. You need to know your costs from A to Z. So start by analyzing the percentage of each cost to the total expenses and also as a percentage of your total sales, because it helps you to know what you need to do, when you need to do it, and how you need to do it. So the timing on costs is critical, so that it can also help you to know, do you need to leverage on technology? Technology helps you to minimize some of the costs. You will have, yes, an initial expenditure, say in investing in a system, maybe an accounting system for your business or an inventory system for your business, so that you can be able to, at any one point in time, be clear on your stocks and the position of the same, know when there are stock outs and know when to replenish and things like that. But it helps you to save on other costs, be they the cost of storage, because sometimes we have these stores and warehouses and keeping lots of stocks in there that do not necessarily move fast, what we call fast moving goods. And so you end up even incurring warehousing costs. But if you knew that to access these particular stocks is easy because maybe your distribution chain is within your locality, then you may actually assess and say you don't necessarily need to have such a big store for stock holdings that are not necessarily translating you into cash in a quick time. So it helps you to make certain decisions that help you to run your business. Yeah. There's the issue of rent. There's the issue of even the resourcing, the people that you work with, you know, whether you pay them on wages or on salaries. I mean, it always helps you to know which are my fixed costs that the business must meet, which are my variable costs that are paid to production or to other activity. Where do I have leverage to be able to, you know, minimize this cost, to be able to operate at a minimum and therefore run an effective business. If you think about the business of Joseph, the example of the electrical appliances that he has to get from China, you actually note that he can decide to get them from China directly, by thereby eliminating all the middlemen, you know, or he can choose to get them locally, meaning he's actually incurring a cost in terms of him forfeiting what would be been a higher margin were it able for him to get them directly. So he can actually choose to get them directly from China. And even if you choose to get them directly from China, we are now in a global village. You don't even have to travel to some of these countries to get these goods, as has been the case in the past. Nowadays, with good contacts, you just need to communicate through the WeChat forum, especially for China being one of the biggest manufacturers of some of these goods, and you're able to send them money using your bankers. You can be able to get some good arrangements for sending them the money, and you receive those goods seated at your location. That already eliminates travel costs, eliminates a lot of conveyancing costs there, and you're able to bring them at a minimal cost, thereby increasing your margin. So expenses management and the analysis of the same is something I would advise us to periodically do, so that at any one point in time, you keep eliminating duplication, you keep advancing in terms of leveraging on digitization and the automation we have in the cost space, and always employing new ways of doing business so that you can be able to have higher margins. Remember, I said business is a margins play. So look at the cash flow cycle. This is a conversion cycle I made to reference to earlier. So from a cash flow cycle perspective, you need to ensure that you have clarity as to how long this process for you takes. From the time you order for goods, they get to your premises, you pay for them, they get to your premises, to the time you sell them. If on cash, well and good, the conversion cycle is shorter. If on credit, then it means there is a collectability application there that needs to happen for you to actually receive that money back to your business, because then it becomes a cycle. So the longer this process takes for you, the more challenging it will be for you from a cash flow management perspective. Because remember the principles we talked about, your cash being available and timely. It means you will probably need to inject money from another source into your business as you wait for your customers to pay you back, so that you have something to work with. Because your business is generating on a daily basis, So this conversion cycle is critical for you to be able to, number one, to know it and master it. And then number two, to also know what you need to employ and at what point in this cycle, so that you can be able to convert your cash back. So it follows that the cash is converted first into inventory, and then accounts payable, then into expenses, into the products. I mean, you know the whole cycle for your particular business. For some, it's shorter. For others, it's longer. The question is, how do you stay afloat in this cycle? You know, and so that's where, through forecasting, because you're able to know what is coming in vis-a-vis what is going out and at what particular periods, then you're able to tell if you have any negative cash flow that will need to be boosted, maybe through a quick bank overdraft. So that's why your arrangements with your bankers is critical, or maybe through usage of a credit card, if you really have to go that route. So having that facility available to you is also critical, or maybe through doing other things to do with invoice discounting, or even LPO discount, just to ensure that your business is running. And that is something that you really need to assess for your own business. So I've talked about accounts receivable, I've talked about accounts payable and inventory, because these are three big key things in your cash management. You need to stock your business. You need, of course, to pay your suppliers, but at the same time, you need to get paid by your buyers. You know, your customers need to make good on their payment. And of course, there are sometimes you'll actually have to write a bit of bad debts because it's part of doing business, isn't it? But these need to be monitored closely so that it doesn't drain your company cash. Yeah, and I talked about warehousing and inventory, where you have sometimes the danger of overbuying and so overstocking. So you also need to be able to establish which are my optimal levels of inventory from an inventory management perspective, so that you don't overstock and you don't understock. But it also speaks to the other dependencies on that, because if your supplier is nearby, then you can be able to leverage on that. If your supplier is a bit far off, then of course the timing of how you do that stocking is critical, so that in my country we say, don't sell hakuna, don't sell to your customers, don't let your customers know you don't have the goods, because remember, there's also the aspect of maintaining and retaining your customers who of course run your business and keep it going. So arrange for inventory deliveries at the latest possible date. That's what I was talking about, just ensuring that you're not overstocking or overbuying. And thereby it also gives you, it frees your cash, because you're able to have more cash to do much more with it for longer, even as you balance. So it's basically a real balancing act between the inventory piece, how soon you pay that supplier for those inventories, and when you sell the goods, how soon you get your money back for those. So those are the the big three, as we call them, in cash management. When you look at the cash flow projection, so cash flow projection, and I'll spend a little bit more time here so that we quickly get this, because this is the lifeline of your business. This is what helps you to know how you're waking up tomorrow and what you need to do to ensure that even the following day you're in business. So you need to be able to show the timing of your cash in and your cash out. So the predictability of how you run your business in terms of the cash inflow, outflow will help you to prepare for shocks, as I'd said earlier. And I want to just quickly get to it on how then do you do that cash flow forecast. So from an in perspective, which is through basically your sales, record your expected sales over time. And for this, I advise you to do it on a monthly basis. So like, for example, we are now in September of 2020. You should always do a running forecast, which is 12-month forecast, right? So you should have one from September 2020 all the way to August of 2021, with every other month increase a month, so that is always a 12-month forecast. So 12-month running forecast for your cash flow. So bring in your sales, because you already have a trend of how you've been doing sales in the past. That can give you a good indication of your sales into the future. Of course, depending again on the seasonality of some of the products that you stock. We know about seasons in terms of maybe if you're in the business of maybe school production material, depending on when schools open, you find your sales go up. So some of those seasonalities in your business, bring them in that forecast so that you can be able to have a good feel as to what is required, when and how. Then of course, your other expected sources of cash over time, you can input that into your forecast. Then your expected payments. So remember, I said sometimes you are allowed from a supplier perspective to take goods on credit. So again, it depends with the relationships you have created over time with your suppliers and whether they're actually able to give it to you on credit, then thereby you're able to push your money for longer. So put that into your forecasted flow. Then calculate the differences between your incoming, the sales, and your outgoing, the expenses. And remember, expenses you put plus your business expenses, because those are an obligation for you to pay. Then you will add the balances at the beginning. So your closing cash at the end of September 2020 becomes your opening cash at the beginning of October 2020. And you run it in that format from a forecasting perspective. When you look at the sales part, the heart of the cash, this is the heart of the cash focus, because really this is what generates money into your business. So these are ultimately transformed into receipts and cash disbursements. And when you do this focus, because of the uncertainty sometimes of the market, you need to bring in three views. An optimistic one, meaning things going as planned. A most likely, you give it a percentage of probability of things not happening as planned. Then pessimistic, you know, that what would be like your worst case scenario. This always helps you to gauge your business with the different unforeseen shocks that come into play, because it's a forecast. You're speaking into a future that is unknown. You're speaking into a future that, you know, you can only work with some macros, be it the from research sites or from what you know based on the information you have in your business. Sometimes government legislation also comes into play in some of the things the government is planning that you know will ultimately affect you, to maybe to do with taxes for those especially that have to import goods into the country. And you know, some of these duties that you pay for the clearing of your goods, they keep changing. In our country, there is what you call a container cost. There is what you call for people who do, you know, they share a container, and so it is or rather it is charged in bits and not necessarily a full container and things like that. So you understand the nuances for your business. So that's why it is important to put a forecast into 3 scenarios. What would be the best from a best outcome perspective? What would be a worst case scenario that's pessimistic, and what then would be your most likely? And then of course you work with your most likely as you go along in forecasting and managing your business from an outcome perspective. And then you need to forecast your cash payments. So start with those payments that are fixed, because remember we said for fixed is an immediate obligation. Your rent is fixed. Your obligation to your workers in terms of their salaries and wages is fixed. Name any other fixed cost to your business, put it there as a cash outflow. Then you can check and review what is in the checkbook so that you can be able to have accurate estimates. So remember I talked about trend. You have been running this business for a while, so you do have a trend. Then of course add a cushion to estimate for contingent purposes. So you'll always put something cushion so that you as a contingent, so that you in case there's something you haven't quite captured, that contingency will be able to cater for it. And what this really helps you to do is the net cash you have at the end of that, you know, trajectory of you putting in your sales, your inflows, and all your other sources, and your cash payments forecast from an outflow perspective, that net difference, you know, if it is negative, you need to inject something into the business at that point in time. So it helps you to forecast that by that time, I will need to put something into this business. If it is positive, then you keep running your business at least with some comfort that you have cash that will be available, that will be timely, and that will be positive. And then of course, estimating the end of month balance. So what I was saying about taking beginning cash balance. So you need to also marry this to what is seated in your cash. Because when we say cash, it has to be reflected somewhere. So the check accounts or the current accounts that you have are the ones that reflect. And I hope and pray that you have separate bank accounts for your business vis-a-vis for your personal expenses, so that you're separating that and actually being able to speak to the underlying performance of your business. So what is seated in your cash account, that's the cash flow reconciliation that you need to do, because that becomes your beginning cash, so that you're able to add your receipts, as we've discussed, from your sales and other sources. Then you're able to deduct your cash payments, the fixed and the variable. Then you have your cash surplus or cash shortage. The surplus helps you to know that you don't need to worry so much. But if you have a shortage, then the question is, do you need to borrow? And if you need to borrow, do you have arrangements in place, or do you need to start having those arrangements in place so that you can have something prepared by the time you get to such a position where you will have a cash shortage? So I think from a cash forecasting, which I had said is really critical for your business, I hope this paints for you the picture around how to ensure you have a 12-month running forecast to help you sustain the growth of your business. Because at the end of the day, you want to be able to have a business that generates for you not just the running expenses, but generates for you some income for investment. Because a time will come and you will have to probably change businesses. So you will need cash to be able to start a new business, or you need to maybe close this one and go into a different line, maybe real estate and others. And you will definitely need to be able to show the value of having been in business for 20, for 30 years. What investments did you put in place so that that future is also as secured. So remember, our duty here is to empower you, not just to run on a very everyday basis, but to actually secure your wealth creation into the future. So I'm hoping that even as you do this, ensure one of your cash payments deduction is what you pay yourself. So that what you pay yourself is well calculated in such a way that it meets your household personal expenses, because of course you have house rent to pay, you have maybe children, so school fees to pay, and what other expenses from a household perspective, but also gives you something for you to be able to invest. So purchasing land, investing in T-bills, T-bonds, you know, those government security lines, whatever it is, ensure that your cash is also safely invested and generating for the future. So we need to avoid the cash crunch, and maybe just by way of summary here, one of the biggest one is on the costs, you know. So there are things in a cash crunch, and especially in the pandemic season that we are, I believe, coming out of and that we have been in, you know, you assess and see what are these things that you need to make quick adjustments to, so that they do not become an impediment into how you run your business. So you may want to consider leasing some items rather than buying, because buying means an immediate cash outflow into your business. Leasing simply means you're able to pace yourself for a period of time until such a time the business has that financial muscle or financial strength to do some of these things. What about non-essential cash outlays, which I think speaks to the poll question on unplanned expenditure. So you need to make some critical decisions around what is essential for the business vis-a-vis what is non-essential, so that you can be able to curtail on the non-essential and keep the essential part of the business going. Negotiating on your fixed loan payments. Of course, in this scenario, we had quite a number of our customers, and most of you could be part of the people that are listening, you know, where we had to give them some moratorium, some repayment holidays, of course, because of the pandemic, so that we give them a little breather into, you know, not feeling that they have this obligation that needs to be paid. Yet, as you rightfully put in the poll questions, your cash flows have been affected. So even your ability to repay some of the loans that you're having definitely becomes a challenge. So you negotiate so that you can be able to have, you know, some paced way in which either a break or a reduced, you know, installment payment, so that you're able to pace yourself and manage your cash flow better. Think about using used equipment as opposed to buying new equipment, you know, something that is usable and can still be able to produce for your business, especially those that may be in the manufacturing sector and you have maybe factories and you need to always keep replenishing this equipment. Sometimes going for outright purchase of new ones can become an expensive venture for your business. So this can be some of the things you employ just to be able to avoid that cash crunch. The hiring of part-time employees and casual workers, sometimes even having employees on contract, so that, you know, your obligation to them, then you have a way of, you know, giving them ample notice where you probably want to scale down, and because you focus that you'll not be able maybe to make full payments to them, so you can scale down your employees. So having part-time or casual workers helps you to make some of these quick decisions. Of course, at the end of the day, there is a part of caring for your workers, but sometimes when the business is not able to actually sustain them, it's always good to have that conversation with them in good time. So some of these arrangements help you to also manage that piece. And of course, many other examples that you could put there just to help you avoid a cash crunch for your business. So having that business plan in place is important. Investing surplus cash is important. As I've talked about, investing your business for future growth is very critical, and this will always help you when that cash is required and required urgently. I'm almost coming to a close, and just by way of closing, we've talked about managing your costs so that you reduce your operating expenses at every opportunity that you get. Managing your trading patterns. How is your business from a trend? So it's good to always look back so that it helps you to forecast into the future. And this is one of the things that you need to do, especially as you do also cash flow forecasting, because that 12-month running forecast is sometimes based on a trend of how your trading patterns has been in the past, so that you can be able to accurately, to some extent, focused into that future. An additional requirement beyond original speed, you need to be able to have speed in the payment of debts so that you can be able to get cash into the business in good time. Remember, timely is one of the key characteristics of cash. Short-term, encourage payment of debtors, so the cash collection piece, and I saw some of you say that it's quite a challenge there. I think one of the key things I would advise you, and especially to that group of people that felt that debt collections is an area of challenge, is having proper credit terms from the onset, so that it's not something that you're having to reintroduce to a customer when they're already in debt. So having those credit terms as you actually make that sale is important, so that your customer also is fully aware of what they're getting into. Is it a 30-day payment credit period? Is it a 60-day payment credit period? Which then in turn you put into your forecast, because you're saying, if I've made sales today on credit, then the cash can only come 30 days, 60 days later, depending on how you run your business. Of course, talking to your local bank in advance helps to really build a relationship where you're able to always check in with your bank as and when you need it, and they'll be able to support you in your business timely. So from an advice perspective, we talked about times where you will have a crisis, or you will have, you'll not have sufficient cash flow to meet your daily expenses or your daily running of the business, as it were. So you may be forced to borrow. So borrowing could be from friends, from banks, from whichever other channels of borrowing. You could be forced also to request your shareholders to put more money in the business, depending on the structure that you have. If it's a company, so the shareholders would have to inject more capital into the business so that it keeps that business running. So all these are acceptable methods of coping with a short-term constriction of funds, and thereby it helps to put that into a business plan so that you can be able to have a proper cash strategy that keeps your business going. And I think, just as by way of example, I thought I would just put this so that when Susan comes in to start talking to us about some of the offerings that you have, you get a good idea as to some of the things that we look at. And one of them is your debt serviceability. And we look at your coverage ratio, which is computed in this example of Nina, who is a real estate developer. And she's worried whether she'll be able to get a loan because she has several other loans. And according to her financial statements, she's got 2 million in operating income, yet she's got some loans that she's paying, and her interest expense is 300 and her principal repayment is 400. So from a calculation perspective, we basically pick the net operating income. So remember, it's net, meaning we have already netted off your business operating expenses from your business income so that you get the net operating income. And we divide that with your obligation with your current loans, just to be able to gauge, do you have headroom? Do you have bandwidth, so to speak, to be able to accommodate more loans into your business? So this helps us to just have an appreciation of your serviceability. And we usually say, if it's at 1, like a 1.0 ratio there, 1.0 just basically means you're breaking even, so you don't necessarily have headroom. So we advise anything to the tune of 1.2, 1.3 going up is a healthy ratio from a coverage perspective to work with, that speaks to you having headroom to be able to get more loans coming into the business. But remember also, loans need to have proper management around them so that they don't drown you, so to speak, because they are being serviced by the business. So that calculation around how quickly you can be able to repay and thereby also keep yourself a good credit score rating, so that you're always eligible for, to be able to access some of these offerings, then becomes a critical conversation. So I think, allow me, in the interest of time, to pause at that point and hand it over to Susan. And as I do so, I think I just want to remind us of a quote by Jack Welch. I mean, you all know Jack Welch, who was the CEO of General Electric for 20 years, and he was able to increase the value of the company dramatically under his leadership in those 20 years. And one of the things that he said is that if he had to run a company on 3 measures, those measures: customer satisfaction, employee satisfaction, and cash flow. So cash flow is truly the lifeline of your business. So lack of cash will burst your wealth creation bubble. And that is why we are here, to ensure that you're fully empowered that you can be able to manage your cash better, then you can be able to thrive in the businesses that you run, and thereby help you in the journey of empowering yourselves to be able to build your wealth and protect it into the future. So I'll pause at that point and welcome back Susan to take you through a bit of the Kenya offering from an Absa perspective. Thank you, and over to you, Susan.
Thank you so much, Caroline. Yes, Letitia, go ahead.
Susan, thank you. Sorry for interrupting there. I just would like to highlight two things. To everyone who is on the chat box, I kindly ask that you please do pay attention to who you're giving your email addresses to. Please do your background research on who you're giving your contact details to. Please make sure that you're safely giving it to a trusted party. ITC SheTrades, we do not intervene in any we do not control any sort of exchanges, but I do want to make it to your attention that that you take responsibility and you do your researches for the emails that are being sent around. Please do be responsible with your contact. And secondly, if you've registered for this webinar, you will receive the PowerPoint and the recording. Susan, before I give it on to you, Caroline, thank you so much for this informative webinar. I think it has really benefited a lot of us, and we will get back to you for questions and answers. Susan, sorry again for interrupting, and please take the floor. Thank you.
Thank you, Letitia, and indeed, Caroline, that has really set the stage for what I will talk about, which is really what you can use to manage your cash, as she was talking about. And I did go to the chat as well, and I found a lot of questions. I've answered some, and I do see my colleagues are also answering. We have our head of trade finance. I've seen Edward Ratemo, Edwin Asiema. I've seen Caroline Onyango, who runs our small enterprises. So I've seen the chat box is actually getting answered, and probably just a note, probably Letitia, we can have a different session where we talk about the financial instruments in more detail that the entrepreneurs can use to leverage on managing their cash flow during this period. I think that would be a good session. So I'll get into the Absa Bank offering, which is really, we do offer long-term and short-term financing. Under the short-term financing, which is really the one that you need to use to be able to manage the cash flows for your business, because the short-term financing speaks specifically to the short-term needs within your business, and it's very specific. So it might be you need to clear goods at the port, and therefore you need to quickly get funds to be able to go and pay your clearing agent. And you know that there are funds that are going to be coming in within the next 10 days. So you can approach us if you're already banking with us, especially because for an excess, you really need to go to a bank that already knows you and can see your cash flows, because it's something very urgent. You need it like today or tomorrow at the very least. So we'll be able to look at your history of banking and tell you, we can give you this type of amount. So normally that doesn't take time. It's a 10-day. Within those 10 days, you can then show the bank where your source of financing will come from to pay that cash. So we do that, and then we offer a line of credit. It's like an overdraft, and I think many of the ones on the call here would be familiar with an overdraft, where you get in and then you let us know. We will look at your cash flow cycle, and I know Caroline has talked about your working capital cycle, so we will see what are the gaps that you have within your working capital cycle, and then we'll be able to recommend what kind of limit is good for your business. I know most business owners will come and they will say, I need 10 million, and maybe what your business can really afford is 3 million. So we'll be able to advise you based on your working capital cycle, the line of credit that we can be able to put in place for you. Guarantees, these are good financial instruments to manage your cash flow. So if, for example, you are an importer, and therefore you need, like I've seen some of the comments on the chat, so you need to import a certain item, and maybe you need to prepay for it, especially now many of you have talked about having to stock up, and therefore you can use a letter of credit. You can approach us, ask for a letter of credit. The letter of credit guarantees your supplier that you are going to pay them because it's backed by a bank. So in that respect, we will exchange a letter of credit between our bank and the supplier's bank that gives them comfort that you will be able to meet your obligations, so they can go ahead and manufacture your goods. And then when they arrive, you can agree on the terms. Do we pay them when the goods arrive at the port and you see the bill of lading documents, or do you agree with them terms of 30 to 60 days before you can pay them? Remember, all this is backed by a letter of credit. So in that respect, you can be able to have that negotiation, given that you're not negotiating on your own right, but you have the bank behind you. So that's an instrument that you can use to support you. Just before I go into other types of letters of credit, I wanted to talk about the guarantees, because there are also instruments that you can use. So you can use some payment guarantees that assure your supplier that you will be able to make good your payment. So maybe you're a supplier for Bidco, right? And you want Bidco to give you some credit terms, right? So that you're not always going and picking your goods on cash. So you can use it locally to your supplier, whether it is Bidco, and then Bidco will take that guarantee. Maybe the value of the goods that you normally would want to take on credit is up to 500,000 or 1 million shillings. So we'll be able to set out that instrument that is to Bidco, and therefore Bidco knows, should you fail to pay, they can call up that guarantee. And as a bank, we will pay them. So again, we will assess you based on the cash flows that are running in your business to see what limits can we give you that give almost a surety to your supplier. There are some who also come for them, whether it's KPLC, so you want to make sure that you're guaranteed power to running your business. And then we also find for contractors especially, you find as part of your contract, the client says they're going to keep 6% of the value of the contract in case something happens to, let's say if it's a construction site, in case something happens that was not foreseen after handover of the project, that they will use that money to then do the repairs. So you can come to us and ask us for a retention bond. That allows you to then take out your cash, so they're not left with your cash, but then you give them an instrument from the bank that allows them to have the confidence that should something happen, their repairs will still get done. So those are some of the instruments you can come to us, and you've seen other sort of bigger suppliers asking for performance bonds. They want to know that you will perform. And at the same time, there's some suppliers who can actually, some of your clients who can actually ask for advance payment. Maybe they have cash, but they're not sure you're going to do the project. So you can actually ask for an advance payment guarantee. So they can give you some of the funds to start off the project. And then as a bank, we issue them with an instrument which we call an advance payment. So that guarantees you the performance, but at the same time, enables you to raise cash to be able to handle the project. So these are instruments we can then discuss and get into more detail. Definitely we can't go into too much detail during this session. I think for me, it's to create the awareness that you can come to us and we can be able to give you those kind of instruments. The other commonly used are the invoice discounting, where you've already done your supply and you've invoiced. However, most of the corporate suppliers will take 30 to 60 days to pay you. It depends on the terms. So what the invoice discounting does, you come to us with an invoice. The invoice needs to be at least 90 days within which you had invoiced. You come to us and then we are able to advance you the cash immediately. Up to 70 to 80%, we're able to advance the cash because we do realize that within the invoice, you have put in your profit. So we are helping you unlock the cash that you already used to be able to do the supply. And we do that. We have an unsecured limit of up to 30 million for that, where we then will vet the corporate that you are supplying to make sure that they can be able to pay. The same to LPO financing, and I think this one is very familiar, local purchase order, So you will come to us as well, tell us this is the contract that you have. It's with a credible supplier that can be able to make payment. You'll show us the contract that you have signed up in terms of the terms of payment. And based on that, we can be able to make an assessment and see how much can we also facilitate you to be able to manage your cash flow. So I want to talk about those as the main short-term products. I do know for some of the entrepreneurs here, we have set up some MOUs with our corporate in a program we call Enterprise and Supply Chain Development. And in this program, we are financing, if you're a startup, but at least you have operated for 6 months and you have a corporate supplier within an ecosystem. So in that respect, we will, currently we do have some MOUs. So for example, we have MOU with East African Breweries, we have MOU with KRA, we have MOU with Kenya Wine Agencies Limited. So you can approach us and we'll be able to give you a list of the corporates that you're currently dealing with, but not to worry, because you can always tell us, this is the corporate I'm supplying. Can you enter into an MOU? And we have a team that can be able to negotiate that MOU and help us be able to unlock the financing for you. So under that closed loop and arrangement, we are then able to finance you if you're just applying the second payment, and the corporate needs to say that you're good for the money, in the sense that they are happy with the work that you're doing. So in that sense, we can be able to support you as well. And then of course we have the business credit card, and therefore that can also be used as an instrument to unlock some of your cash. You realize that for the credit card, sometimes it's 45 to 50 days for you to pay. So that gives you some flexibility in terms of cash flow. And then we have the longer term financing, where you want to purchase equipment, you want to purchase machinery within your business, or you want to purchase a movable asset. So we do finance that under the asset finance arrangement, and I've put the terms there for you. Business expansion loan, and I did see a question from one of us there asking, how do I manage the cash that is required to stock my business for it to run, right? So you can come for a business expansion loan that really helps you to not, because you have to retain a certain threshold of stock for you to operate. And that threshold is almost like capital in the business, because you can't reduce it. If you reduce it, then you're not in business. So you can come and ask for a loan of maybe 3 years, 2 to 3 years. That's what I would recommend. I know as entrepreneurs, we want the longest period, but remember you're paying interest to the bank. And therefore that enables you to manage that capital that you need to keep within the stocks in the business for you to operate. So again, you can come to us. Or you already have an asset, maybe it's a residential premises, and you are receiving rent. And therefore you're saying, I want to unlock that capital that is already in the asset to get either working capital for the business or do something else that you need to do within the business. So you can come to us and we can be able to assess how much can you be able to unlock from that asset to be able to run your business. And commercial mortgages and business mortgages, I think well understood. So I want to go to what we need because of time. I can see our time has really gone, but I'm happy for us to have a different session where we get deeper into this. So I did see some questions there around, can you use the M-Pesa to be able to look at your cash flow? Definitely, because M-Pesa is a mode of payment to your business. So as part of the requirements, we normally say, if the M-Pesa till is not settling to your bank account, which is where we have asked you for 12 months bank statements, attach the M-Pesa statements for us to be able to do a holistic review of all the various cash sources within your business. So that's one of the things that we do take, and we are then able to assess how much can you repay for a loan. So that's really, some of these are really compliance documents, you know them, you have them, and therefore just to be ready with that. In terms of how long have you been in business? I know many of us started the business probably in your house before you finally took the leap of faith and started paying rent in a premises, or even registered it, right? We do count when you started the business from when you started it in the house. So we don't look at the date of registration, we look at when you started, and that's how we gauge. So For business women entrepreneurs, we look at it from a 2-year period. At least you've operated for 2 years, and you can verify that with whether the M-Pesa statements or the bank statements or SACCO statements. You can then come to us and we'll be able to do an assessment. The last slide is really around the commitment that you then give the bank, because sometimes you've seen we do have some unsecured limits, but once the unsecured limit is exhausted, we then need some form of commitment from you to see how can we do it. So again, when we assign receivables, you've seen we can go up to 30 million in unsecured debt, meaning you will just assign that invoice to us or that contract to us to make sure that that then becomes our security. But then when it's going above an invoice and it's above the 6 million limit, then we can say, can we assign the company assets to form part of your security? Land and buildings, you're very aware of. Last session, Caroline did go into treasury bills and bonds and investing. You can use some of those interest instruments to be able to secure your facility as well. Or you can use third-party securities. Some of the instruments I've talked about, whether it's guarantees or letters of credit, can also be used as security for your debt. So you just need to be smart to understand what kind of instrument can I get that can still act as a comfort to the bank. So I'll stop there and see if there are some burning questions that we can be able to review during this session. If not, we'll definitely keep the conversation going and keep answering them for you. But thank you, Absa team, for really being at hand to answer most of them already. So Letitia, I think that's where we are. Thank you very much.
Susan, thank you so much for going through each step and elaborating on all of these points and the products and services of Absa Bank. Thank you so much. For everyone here, please, I know there are a number of questions that are that were asked. If you could please also, we'll take what time is it now actually? We'll take another 5 minutes to answer questions and then we're going to wrap up. So please take this opportunity to ask your questions. If you feel like your questions have been buried in the chat box, please do bring them back up for us just to see it now, because the chat box has been very active and we might have missed your questions. So please do bring back please do write again your questions, and we are going to be answering a few right now. All right, so let's see what we have. Give me a second. And Susan and Caroline, if you think I've missed anything, please feel free to jump and answer any questions. But for now,
Letitia, I can answer this last one I have just seen from Sarah. Sarah is asking whether you are still eligible for the bank financing facilities, even if you're not an Absa customer. Yes, you are eligible. I think what we just need to see is your track record from where you're currently banking. And then definitely the objective is that then you will also be able to have an Absa Biashara One account opened with us to be able to be our customer at the time that we are financing you. But you should start already banking with us.
All right. Wow, and this is very nice to see. Everyone's been very engaged in the chat box. Yeah. We have a question from Miss Bernice, and she's asking, during this season, stock outs from suppliers are quite common. We therefore have to overstock in order to avoid stock outs. How can we manage cash flow during this time, yet the margins are not increasing? I think this one would go for Caroline.
Yeah, thanks for that question. I think my advice to you would be, in as much as there is a tendency to overstock because of the reason that you have given, that the suppliers' stocks are actually running out. And so there is that tendency to overstock. The question should be, for you and your business, what would be the rate of sale? So if you also do not have a quick plan around your sales, that you'll not be able to convert this stock into sales and actually sell them out, then I would say strike a balance, because by stocking, you have literally closed out your cash. You know, you have basically put, yes, capital into your business through the stock, but you have basically committed whatever cash you had into this stock. So if you don't have a proper channel, outlet channel through sales, then I would say temper down, in as much as there is that you can say shortage in terms of, you know, the inventories. Just taper down what you stock so that it's just in line with how much you can be able to sell. That way you strike a balance. Cash management is purely a balance play. You don't have too much, you don't have too little, you just have enough for what you need to run the business. So it's just a question of assessing in terms of this supply. Fine, seemingly looks like there's a shortage today. Is it something that is temporary? Is it something that is slightly longer in terms of them, you know, quickly being able to bring in the stock? Or if it's shortfall, then you don't need to stock too much. If it is a bit long term, you can stock a little bit more than you ordinarily do, but not so much in excess, because then you'll be left with all this stock if you're actually also not selling. So it's just a balancing act based on the two major principles of in and out. That would be my advice to you.
Excellent. And then we have another one. It's asking, in terms of overbuying, what if I have the money now and I'm afraid the money of raw materials will go high in future? Okay. In terms of rephrasing, I think he's afraid that he will buy, that he has the money now, but he's afraid that the price of the raw materials will increase in future. Should he be worried about buying his raw materials?
Yeah, that's a really good question. And I like the fact that that person actually says that he has a forecast that the raw materials prices will increase. That's the whole essence why you do a cash flow forecast. For that reason, you can ensure you secure what you can today, right? So that you buy at a lower cost to be able to safeguard on the price increase that you're forecasting is coming into the future. Again, strike a balance with whether if you bought X quantity today so that you can be able to say to safeguard your business from the price shock with it intended to increase into the future, how does that sit with your cash position? Because again, if you overbuy and you have to borrow to overbuy, then the cost of borrowing is an opportunity cost conversation. The cost of borrowing vis-a-vis the cost of what that price incremental would have been, which one is the lesser evil? Then you make a decision based on that. But that is actually the power of forecasting.
Super. And we have another question by Wanjiru. How do banks evaluate the financial health of a company in order to avail an overdraft?
I'll give that one to Susan.
Thank you. And I did allude to it earlier when I talked about your you reviewing your working cycle and us understanding how long does your business take, I mean, from order level to when you receive it to when you sell, what's that working capital cycle? And then we review that and then look at what then is your working capital gap. That's what we use to be able to review the financing that you then need for us to give you as a working capital finance. And probably we can get into a little bit of more detail at a different time, but please feel free to then write to us. I know I have some trade experts with me here. I have Edward Ratemo, I have Edwina Siema, and we can be able to do that review for you. If you are closer to one of our branches, I'd encourage you to go there. Go in with your 12 months bank statements, and then we're able to see the flow of cash within your business. And if there are any other cash sources, please make sure you come with everything so that we are able to do that assessment and give you a good view of what can you access. Thank you.
Thank you, Susan. We also have here, hi, Susan. I'm not sure if you've answered this or not, but hi, Susan. With the secures you've mentioned, if there are any defaults, does that put the business at risk?
I guess the fact that there is a default, it means there's a risk in the business already. Yeah. But what we seek to understand is to understand what is causing the business to have strain to be able to generate cash flows. And especially in this COVID environment, where we are actually giving a repayment holiday. If you had already taken a loan and your loan was current as at March, we're able to review and give you a repayment holiday. And many of the clients I've seen here, there's some in the tours industry, hotel industry that have been greatly affected. Some of them is not because of their own, but it's government restrictions that have affected their business. So we're able to have a discussion to understand, do we need to restructure? Have the cash flows reduced to come to pay the loan? So do we give you a longer tenor? So those are the discussions we normally would have, and go into recovering the asset as the last resort. Your business cannot wake up at all. That's the last resort for us. So it's really a comfort to the bank. It's a form of commitment, like I put it. It's your commitment that you're going to put your all into it, even as we support you in financing the business. It's normally a last resort. That's what I would say.
Hi, Susan, there's one more question. Do you have cash to loan women-owned businesses?
That's a good question. I think lending is our bread and butter as banks. And we rolled out a fund for 10 billion earlier this year in February. Our CEO did announce a fund for women, 10 billion shillings to be lent out to women. And this fund is what we're utilizing to even have this partnership with ITC, where we are their financing partner. And therefore, yes, we have money to lend.
That is great news, Susan. And then we have one on cash flow, which is, can cash flow be sheltered by depreciation?
Just repeat that again, Letitia.
Can cash flow be sheltered by depreciation?
I would say not necessarily. And the reason I say that, because remember, depreciation is just now an accounting policy of how you amortize for your capital items, if I understood the question correctly. So depreciation is not a cash outflow. The cash outflow has already happened through the expenditure of that capital item. So it has happened as a one lump sum payment. So depreciation is just, an amortization through that period. And remember, when you do cash flow statements, for those that actually get to do it, depreciation, which is not a cash content item, is actually removed from your profits for purposes of actually doing a proper cash flow statement. So you eliminate it because it's not an actual cash, cash out. The cash expenditure of purchasing that particular CapEx item that you have purchased for your business is the proper cash outflow that needs to be considered for cash flow analysis. But if the other coin of that question is what I talked about, managing the cash crunch, where instead of an outright purchase that actually, let me give a perfect example. Let's say you're buying a factory equipment that will cost you, say, 50 million. Yeah, you need it, of course, for the production of your goods because you're in the manufacturing sector. So 50 million is your cash outflow. That is cash out of the business. So from an accounting perspective, that's why I'm talking about depreciation, which just helps you for financial accounting purposes. But you could consider leasing that equipment so that you do not necessarily spend 50 million as an actual cash outflow of your business now, but through leasing, you just pay some monthly rentals, which help you to pace your business from a cash perspective. So you probably pay what, 2 million every month for the right to use that particular asset, as opposed to you buying it for owning. So those are some of the levers you can play when you don't necessarily have that amount of cash to pay out as a cash outlay.
Excellent. Thank you so much, Caroline. So what we're going to do now is we're going to answer one more question from Ms. Pamela. And while we answer this question, I'm going to put up a poll. It's one question just to have feedback on the presentation and the webinar. And I kindly ask Ms. Caroline and Ms. Susan, just after answering this question, to give your final word, some feedback, some tips for us to finalize this webinar. The question from Ms. Pamela is, do you consider women-led startups that have scalable products for financing?
Susan, I think you can take that one.
Yes, I can. So definition of startup, I've elaborated what that is. Yeah. If it is something that is within agriculture, we do have an agronomist internally who can be able to review and advise the best way of structuring the finance that you need. What I do say for pure startup, because we really need to understand when you say startup, is it 1 year? Is it 5 years you've been running on and off? So we really need to understand what startup is. Normally, we would review businesses from 2 years going up, and where it is going to larger amounts, sometimes we go for 3 years and we want to see that the cash that you've been generating is positive. However, I did say that within the Enterprise and Supply Chain Development Program, that program looks at forward-looking cash flows. And therefore, if you're already in an ecosystem and you're doing a supply, then we can be able to review and see how much can we give you. So we don't ask for too much documentation under that program. We ask you for your 6 months bank statement, and then we have an MOU with the company that you're doing the supply for. So in that way, then we are then able to review. And just as my parting shot really is to say that during this period, you really need to review as an entrepreneur, how much money do you really need? Don't take what you don't need because you need to really conserve your capital. So I do hear the questions that have really come around overstocking. And one of the things I have noticed just in the line of business is that many of us are overstocking because primarily we've been used to getting our supplies from China. And the fact that China was locked for a bit, we panicked and therefore said, okay, we need to really get our stocks in. I think it's also time to reflect and see, are there any other sources of getting stock for your business so that then you are not you're not feeling the pressure to overstock. As Caroline was saying, you have worked out, this is what I need, and my reorder level should be when I reach here. So that then you're not putting in some stocks that could end up being dead stock, you know, depending on how the economy is going, because the demand we have also seen has gone down by almost 30 to 50% in some areas. And therefore you could be overstocking, but then you end up holding the cash for so long and you're constricting your business because it doesn't have cash. And maybe you stocked it in a certain item and then you found your consumers are now looking for another item, which you can't afford to get. So I think it's really important to review that requirement and think of what you really need, and then have the conversation with us to then be able to see what can we do for you. So that's what I would advise business owners at this period. Letitia?
Thank you, Susan. Thank you for clarifying this. All right, so what we're going to do next is I'm just going to ask Caroline and Susan to give some final words, some tips, something to take into consideration, especially now because we are still facing the pandemic. So I'm just going to give the floor to both Caroline and Susan. And from then I will share the PowerPoint presentation and recording. So you will receive the whole package. Okay, so you will receive from last week and this week, and we will be planning for more similar training webinars in regards to cash flow, financial instruments, and really focus on the financial aspect. But we will get back to you and we will communicate to all of you later this month. All right. So with that said, Caroline, Susan, would you like to say a few things?
Caroline?
Okay, so I think mine is just really to first say thank you. Thank you to all our listeners. Even as I see the poll taking place here, I'm glad to note that you have felt that this particular session was quite helpful to increase your skills and your capacity in how to manage cash flow. I think my encouragement to all of us is that you will definitely, as you run your business, have seasons, but seasons don't last. So in as much as, like in this case, we are in a season with this pandemic, as I said earlier, I am looking to see this pandemic coming to an end, so to speak. At least we'll be able to come out of it and we'll be able to have our businesses restored. So yes, it's true. There are times you will have your negative cash flows. There are times you will enjoy positive cash flows. And both are part and parcel of how we run business. And because of the skills and the capacity building that we are doing in helping you to identify and be able to monitor the same, I am sure you will be able to come out of these seasons a stronger person, more skilled, and ready to face the future that is ahead of you. Because every company at the end of the day, every SME, even for you at a personal level, I like speaking about households because really the skills that you employ in your household are the same skills that you also probably carry into your business. You must focus on creating positive cash flow. So my final remarks to you as we end this particular session this morning into the afternoon is that number one, cash cannot be tweaked. So you cannot cheat cash. I want you to always remember that. So remember to keep an eye on your cash. It is the metrics that is highly considered by investors. It is the metrics that determines the survivability of your business or your company. So it is very critical that you never leave your eye off the cash. Why? Because it is at the end of the day, the barometer that measures the healthiness of your business and determines its survival. So keep your eyes on the cash at all times, and all the very best. Thank you.
Excellent. Thank you so much, Caroline. Susan?
Yeah, for me, I think I've given quite a number of parting shots, but just following through on what Caroline has just said. I mean, for us as human beings, we're able to wake up in the morning, look in the mirror, and you see yourself looking healthy, looking well. But for your business, this is the mirror. If it has no cash, then it's not looking well. So I think it's to really get into the tools that can help you manage cash flow. From an Absa Bank Kenya perspective, we've launched an SME toolkit that we can be able to give you access for free if you're an Absa client, and you can reach out to us through our businessclub.ke email address to be able to access this tool, and it can help you do your cash flow forecasting there. And you can open an account today for you to be able to access the tool for free. Other than that, you can then get into the other tools that are available in the market, whether it's QuickBooks, whether it's Sage, for you to be able to see how do you get a tool that helps you manage your cash flow, or just a simple Excel sheet. As long as you're able to put in this your expenses, put in the rows of how much are you spending every month. As it is, if you do it for the last 1 year, you are able to now project going forward what you think it could get to as a business owner. But I think it's really important that you're really close to the cash, always understanding what it means. I always say the good entrepreneur for me, and I always know this is the one I need to give my own money if the bank won't give, is the one who understands how the money is going in their business, because that person can then be able to take care of the money that I'll give them. So that's what I will do with you as a parting shot. We really wish you well and continue to keep safe. I know we will get further engagements in this partnership with ITC, and will be available to help you walk this journey. Thank you very much.
Excellent. Thank you so much, Susan. And thank you today. Please enjoy the rest of your day, and we will be in touch with you. And thank you again so much. Goodbye.
Thank you.
Bye, thank you.
Bye.